So I'm Andrei Anisimov, co-founder of Hypersurface and the protocol for structured yield. And today we talk about why is it selling volatility in TradFi is a $150 billion market, whereas in DeFi, post-DeFi Option Vaults, it's sort of like a taboo. No one talks about it. There is no new products that take advantage of harvesting volatility or earning yield based on volatility. So if you're long enough in DeFi, you remember DeFi Option Vaults. They came to market around 2021, became very popular very quickly by promising return on your native assets.
So something like, oh, you can outperform your fees by depositing to DeFi Option Vaults. Of course, it all ended poorly because fundamentally, this strategy is never gonna deliver. You can never outperform
buy and hold by selling volatility. And the main feature that makes this product now work is the fact that they were denominated in a native asset. So meanwhile, in the same time frame, in TradFi, you have cover call ETFs like JEPI, JPQ, exploding in popularity, reaching 150 billion of assets under management. And essentially, it's just a vault that denominated in the USD that holds stocks from S&P 500 and systematically sells cover calls against their portfolio. And so let's look
why, what makes this product different? Why did it succeed? Why DODs fail and this succeeded? And when you look at JP or what it is, if you look at its price per share, it's sort of like an investment that kind of trends sideways. It doesn't really make money or lose money, but it pays a dividend yield. It pays dividend yield between 8 to 10%. When you add the dividend yield to it, now it kind of makes more sense why people would invest in this, because
on average, it makes money. So, however, let's compare it to actual S&P 500. If you compare it to S&P 500, then it's clear that S&P 500 has much higher return. Then you asked, then why would JP be so popular if its return is like twice, 2 times less than S&P 500? So can we ask a question, can an investment be more attractive even if it has lower total return? And the answer to this is yes. And that is why JP is so popular. It's because when you put these investments and compare them not only on the basis of total return, but also on the basis of the max drawdown, meaning that how much that unlucky guy who ended up buying this local top, how much money he lost at the bottom, right? And S&P 500 is a high return, high drawdown product, and JP is a low return, low drawdown product, and drawdown is almost 2 times less. Meaning, if you are an investment manager, let's say at a pension fund or somewhere where you're looking for an income-based product, you prefer JP because you run less risk of buying at the wrong time and not being able to exit at a favorable price. So basically, lower drawdown means the timing of investment less important, and this is what typically people look for when they choose income products. They don't want to trade the market; they just want to invest and earn a reliable yield. So basically, S&P 500 is return optimized, and JP is income optimized investment. And so what we can see is that selling volatility, selling volatility doesn't make returns higher. It actually makes return lower, but it makes the volatility, it compresses the volatility and spreads returns over time, smoothing out the return profile of the investment. So now, what if we run a thought experiment and do the same thing, but with Bitcoin as the underlying asset? This is the logarithmic price of BTC buy and hold strategy, pretty volatile. What if we simultaneously sell cover calls?
Sell volatility, what is it gonna look like? And so the blue line is the performance of the strategy that combines holding Bitcoin and systematically selling cover calls
against it. And even without crunching the numbers, it's very clear that it's a lot smoother. Like in terms of, even if you entered here at this top, you would have to wait a lot less time before recovering back into green with this strategy than with a Bitcoin buy and hold. And this is what makes it a lot better profile to be an income type investment, right? And so now, if we subtract the dividend from it, and the dividend is 60%, so imagine that we can create a vault that has a price per share that looks like this. Yes, in the early days, It's very volatile, but we see that volatility kind of compresses and it somewhat moves sideways and pays 60% dividend yield, meaning that you can essentially make all of your money back in less than 2 years, and then you just earn yield. In order to enable this product on chain, what you need is deep liquidity to be able to sell at size, to sell volatility at size at fair pricing. Unfortunately, right now, this is not available on chain at all. You have to go OTC, meaning you have to go the custodial route, centralized. At Hypersurface, we're working on solving this problem and enabling products like this fully on chain, non-custodial way. My name is Andrei Anisimov. Thank you so much.